The session that I'm conducting today is on how to build a mutual fund portfolio. Now, there are diverse opinions with regards to investing in mutual funds. While some believe it's easy to select the right fund for their portfolio, where there are others who feel that investing in mutual fund is a difficult task. Now, the way I would like to put it is selecting the right fund is somewhere in between. With the right guidance, knowledge, and information, this could be easily achieved. But then the question that we need to ask ourselves is just having the right fund in the portfolio is enough to achieve our financial goals? The answer is no. The reason is the path that we take for making investments is also very important. A wrong approach towards investing could derail our investments. Therefore, before we even begin to discuss how to build a mutual fund portfolio, first let's bust some of the major misconceptions which preoccupy investors' mind and could prove to be a roadblock in their journey to achieve financial freedom. It's very important to get rid of some of the misconceptions that are there in the industry before we even start investing. And one of the major is mutual funds are like stocks. This is one of the most major misconception that is very prevalent in the industry. The only common thing between mutual fund and stocks is that they both belong to equity class if it's an equity mutual fund. And the thing is, they both are long-term investment avenue. Barring that, there is no commonality between mutual fund and stocks. So the factors that you look at selecting a mutual fund is very different from that what you look at in stocks. So don't confuse between the two. Expect past winners or will continue to be the winners of the future. This can and cannot happen. There is no guarantee for that. If this is what you are considering while making investment, then do remember the mutual fund sahi ad on TV. Past performance is not a guarantee for future performance. Low NAV is better than high NAV. Even after so many years of creating awareness around mutual fund investing, this still continues. Again, people tend to confuse low NAV with low stock price, and that is wrong. The mutual fund invests in multiple stocks, and therefore its NAV takes into account all the stocks that are there in the portfolio. In simple words, the opportunity for generating high return is the same in the fund with low NAV as in high NAV. So don't let NAV be a factor for selecting fund. In fact, it shouldn't be a factor at all. All mutual funds are the same. No, not all mutual funds are not the same. Mutual funds are from different categories. There are fixed income mutual funds, there are equity mutual funds. Equity mutual funds, there are large cap, mid cap, and small cap. Every mutual fund offer a different proposition, has a different risk levels attached to it. So all mutual funds are not the same. Mutual funds carry low risk. Mutual funds, whether equity or fixed income, are market linked. So they do carry market risk. So obviously equity funds will carry higher risk than a debt mutual fund, but it's not low risk. They do carry market risk, so one should be cognizant of that. When is the right time to invest in fund? If you're a long-term investor, anytime is the right time to invest in a fund. If you have an investment horizon of say 7 years, 10 years, or even for 5 years, you don't really have to look at the time. You just invest, and that is what the discipline in investing is. Now, some of the common mistakes that we have seen, that investors make, and mostly it revolves around the performance bit. Investors tend to focus on short-term performance while making investment decisions. Now, they don't really see from what are the drivers of the performance. Maybe the fund has taken higher risk, and maybe the fund is exposed to some of the riskier segments of the market, and that would have enhanced the risk. And because of that enhancement of the risk, the returns might have come in. So I think these are the things that needs to be focused on, not just the short-term performance. A lot of investors tend to shuffle between funds in search for instant gratification. So if they are invested in a fund which is not doing well, they will shift their assets from this fund to another fund which is doing well. And we have done a study on that, and I'll come to that a bit later in my presentation. But that is something a very counterproductive kind of an investment approach. Most of the investors tend to redeem in bearish market and invest in times of market exuberance, something that we have seen in the recent times after the COVID rally that we have seen enhanced flows. And, I think what is important for investors to understand is stay through the cycle. Don't look at performance from a short-term perspective, because it won't help in the long run. So ideally, when the markets are down, then you should try and build your portfolio in fundamentally sound mutual funds and stocks if you want to, so that you can run through that upturn and make more profit. Next slide, please. Now, since we have already understood, what are the pitfalls that we need to avoid, let's look at what would be the right approach while selecting the right fund. Now, there are a couple of things that we need to discuss. And two important things that one should follow is, do we need diversification and whether it's really long-term? And the answer to both is yes, we need diversification. And let me explain a few of the next slides why diversification is important. Now, you might be wondering what this slide is all about, why we have all these cricket players on the screen. The reason is do you really want to have them as your top 6 players in the team? Now, one of the most common aspect about all 6 of them is that they are opening batsmen. Now, when you build a team for stability. You need to have a bowler, you need to have a fielder, you need to have an all-rounder, someone who can come late in the innings and play a strong knock if required. The idea is to have a stable team which can sustain different conditions. Every pitch is different, every country is different, and the environment there is different. So the idea is to have a team which can withstand all those different conditions. And that's where you need to have different type of players within the team. And it's the same for mutual funds as well. You need to have different kind of funds which can play their role in different kind of environments so that your portfolio is stable and it is more equipped to handle the turbulent times that we can witness over a period of time. Can we have the next slide? Now, this is a very interesting slide. It could be a bit daunting looking at these slides, but let me explain. It shows how different asset classes have performed on a calendar year basis since 2013 till 2020. Now, the asset classes that we have considered here are fixed income, gold, and equities. And you can see that none of these asset classes have consistently been the top performer across each and every calendar year. Right. So there are a couple of things that we need to, as a takeaway from this particular slide. One, the markets are cyclical in nature. So not one type of investments will be the top performer throughout. Second, every segment and asset class goes through a cycle. So one should try and diversify the portfolio across asset classes. Now, this is while this is applicable for asset class, it's also applicable within the funds. Now, we have discussed about diversification earlier, but it's important to understand that diversification is not one-dimensional, it's unidimensional. One is diversification across asset classes. Then in case of equity mutual funds, it's diversification across different categories, say large, mid, and small cap. Then another level of diversification can be based on manager's investment style. A manager can have a growth style of investing, value style of investing, or blend kind of investing. So in fact, 2 funds from the same category can be different based on manager's investment style. And having 2 funds with distinct investment style can also offer a really good diversification. And this is one of the most important aspects while selecting funds for the portfolio construction that investors should keep in mind. The next is long-term investing, and long-term investing is the part to successful investing. For that, we have at Morningstar, we have done a couple of studies, and I would like to throw some light on those studies, which will actually re-emphasize the fact that short-term investing may not really be useful for investors and could be counterproductive over a longer time frame, even if they are invested over a longer time frame and they are not sticking to the long-term thesis of investing. One of the studies that we did is there a good time to buy or sell actively managed funds? Now, what did this study did? We took a period of, say, 10 years, that is 120 months, and we tried to find out of these 120 months, how many funds actually contributed towards the overall performance of Indian stocks as well as for mutual funds. Now, the results were pretty shocking. Out of those 120 months, only 11 months have contributed towards the overall outperformance of the Indian stocks over cash. That is just 9.2% of all months. In case of mutual funds, on an average, it's even more shocking that only 6 months have contributed towards the overall outperformance, and that is just 5% of all months, which means that if investors would have not stayed invested in these months, which have been mentioned, then they wouldn't have made enough gains while staying invested. This largely happened because investors tend to move in and move out of the funds. So the idea is that in investing, it's more about time in the market rather than timing the market. Another study that we did, which is called Mind the Gap. Now, what does this study did? over a period of time, we have noticed that the investor return can be very different from fund return. And technically, and obviously fundamentally, what we have seen is the investor return is typically lower than the fund return. So if you look at over a 3-year, 5-year, and 10-year period, an investor would have made 1.4% less return than the return that has been generated by the fund that they have invested in. And over a 10-year period, this number is even higher, 2.8%. That is 2.8% less return than what the fund they have invested in would have delivered. Why this happens? This happens because investors come in at the wrong time and invest and redeem at the wrong time. They might have come in the fund chasing performance, and when the performance is good, they would have entered the fund. And when there's a downside, when the fund goes through a down cycle, they redeem their investment and move towards another one. And they, in bargain, they end up losing on the opportunity that the fund would have captured while on its upcycle after the downturn. So all these two studies points towards that once you invest in a fundamentally strong fund, you stay invested, go through the cycle. If it's a good cycle, stay through it. If it's a bad cycle, if the fund is fundamentally strong and still add for your portfolio, bring more investments into it, cost average it out, and then stay invested so that you can capture the upturn in the fund. Something that we have seen in 2017 and 2008, from 2017 to 2022, in fact, there was a cycle like 18, 19, 2018, 2019, 2020, when a growth style of investing was not working. And then after that, value style of investing started to work. So, I think these are some of the things that investors should keep in mind about the long-term investing if they want to invest. Now, this is a very important chart, and I'll just quickly run through it. What are the takeaways from this slide? One, the longer you stay, the higher returns that is the power of compounding. The longer you stay, lower the chances of negative returns. The longer you stay, lower the risk as shown through the standard deviation number. So longer term period reduces the risk in your portfolio. Longer term investment reduces the chance of delivering negative returns as well. Can we have the next slide? Right. Now, since we have already studied, learned so much about what needs to be done for making investment, now let's just focus on the fund selection, the factors that one should consider while investing. Now, there are multiple options. One has to look at them and select what is more apt in their portfolio. A lot would be guided by, obviously, investors' asset allocation, but still, fund selection is a critical part, and abundance of options available does pose a challenge to figure what suits them the best. Now, what one can do is to have screeners. They can start with having some screening done on the fund, and post that screen, they can do some qualitative analysis as well. So it can be a mix of quantitative as well as qualitative analysis. Can we have the next slide? Now, Morningstar ratings are star ratings. That these ratings are essentially risk-adjusted return within the category. So they are comparable within the category. Now, Morningstar star rating does indicate that how the fund has done in the past, after accounting for risk. So it does take into account the risk. Although it's backward looking in nature, it's basically tracking the past performance along with the risk, but the efficacy is pretty good. And these ratings can be used as a very good screening tool for the fund. So here, if within a category, if a fund has got a 5-star rating, that fund is better, obviously, than the fund that has got a 4-star rating. It's basically an achievement test, but can be used as a very good screening tool for the initial screening out of funds. Can we have the next slide? Post that, we at Morningstar, we did realize that star ratings does not really indicate what the fund is going to do going ahead in future, and that is where we came out with our Morningstar ratings. That is, these are qualitative ratings. These are subjective ratings where we give an opinion on the fund as to how the fund is going to do over the long term going ahead, and this long term is not less than 5 years. We assign, there are 5 qualitative ratings or Morningstar analyst rating that we assign. One is gold, silver, bronze, neutral, negative. Gold, silver, and bronze are positive ratings, where we are essentially saying that the fund is going to outperform its benchmark index and category peers over a longer time frame. The changes, the different in gold, silver, and bronze is based on analyst conviction. We have certain parameters, and we will quickly look into those parameters as well. in my later slides. The gold fund might be ticking all the boxes there, but the silver fund might be lagging in one of those parameters, and that is where it's rated as silver. This is a very good and comprehensive analysis that we do and could be also looked into by investors if they want to know most of the qualitative aspects of the funds. Can we have the next slide? Now, it's very important if someone is using Morningstar analyst rating, it's very important to understand what this analyst rating is. One is a forward-looking opinion where we are saying that how the fund is going to do in future and over a longer time frame. And as I mentioned earlier, the longer time frame is not less than 5 years. It's investor focus. So if there is a benefit of doubt that needs to be given, we don't give that benefit of doubt to fund house, or fund manager. It goes towards the investor. So it's largely investor focused. What we try to understand that if we are giving a rating to a fund, is this fund apt for investors or not? If it is, and that is where we tend to focus their aptness more than compared to the fund or the fund house. It's very comprehensive in nature. It's a very detailed research. Once the research is done, we come out with a very comprehensive report on based on our analysis. We give our opinion on various factors and parameters that we look at and tell whether it's good, what is good, and what is bad. So that's a comprehensiveness that we try to follow in our research. Can we have the next slide? It's also important to understand that what Morningstar ratings are not. So it's not a short-term view. What we are not saying that over a shorter time frame, these ratings will do well. We are always long-term focused. It's not a market call. We are not saying that markets are going to do well, and that is when these funds or a gold or silver rated fund will do well. It's not a market call. It's not a buy, sell, or hold recommendation. Why this is not? Because maybe for a small cap fund within the category, we may assign a gold rating, but that gold rating may not be a best fit or a good fit to all the investors, right? So it's not buy, sell, or hold recommendation. Negative rating is normally where we are a bit cautious, where we feel that there's something fundamentally flawed, which may actually impair or hold back the fund's performance. That could be sort of construed as a sell call. Can we have the next slide? Now, let us look at the framework or the parameters that we look at when analyzing these funds. And these are really help in building the portfolio and understanding the fund, which fund is apt for what kind of an investor. So can we have the next slide? So first parameter is people. Now, what is people? People is about the fund manager, their experience, their history. We do a detailed analysis on the fund manager, what has been his past history, what is his capabilities, what is his skill set, where his expertise lies. Apart from manager, we also try to understand what his workload is, because we have seen managers who are managing multiple strategies, from different categories, which have a different mandate, and that could actually, impact their productivity at times in some of the funds where there could be some of the funds where they would focus more, and there could be some of them where they're not focusing more. We try to understand that as well. We also try to understand what is the underlying strength within the team. Who are the co-managers? What is their experience and expertise? The analyst team, how big is the analyst team? The amount of assets that a fund house is managing. Do they have the right kind of resources within to manage that kind of an asset? All these factors we try to capture when we analyze people pillar. A lot of time we are asked with a question that if there's a change in manager, what it means for the fund. Now, for our rating, if there's a change in manager, for instance, if an experienced manager leaves and an experienced manager come in, then it may not be a meaningful change. We just have to analyze and see whether the current rating is apt for the new manager or not. But if there's a manager who is leaving, who is experienced, but a new manager comes in who is an inexperienced manager, then obviously it will have an impact on the fund rating and our opinion on the fund as well. Can we have the next slide? The next is the process. The process, we try to understand how strong and how differentiated the process is. What is the strategy? Is it large, mid, small cap, multi-cap? Within that, the way in which this fund is run, does it differentiate it from the peers or not? What kind of investment style that is being applied to manage the portfolio, that is growth, value, or blend? Whether a team has the capability and the skill set to run a particular strategy or not. We also try to understand whether it's a buy and hold kind of a strategy or a momentum-driven strategy, and we are indifferent to both. We are not saying that the momentum is bad and buy and hold is good or vice versa. If the team has the skill set to run, for example, a momentum-driven strategy, we are fine with that, as long as they are able to play to their strengths, as long as they are able to deliver what they are supposed to deliver. But for instance, if a manager is a buy and hold manager and starts trading around, this does indicate that he's trying to play, maybe the performance is not good, and he is trying to make some quick gains to bump up the performance. That is a concerning part. We also look at the risk management practices that the fund house has set up based on liquidity management, the concentrations around sector and stocks, also capacity management, very important in case of small cap funds, which can face capacity constraints given the size of the fund, and which may hold the manager, applying the investment strategy that he normally applies. Can we have the next slide, please? Parent is a fund company. This is an AMC, for example, ICICI Mutual Fund or Kotak Mutual Fund or ICFC Mutual Fund. We analyze the parent, the company, because the policies of the company does have an impact on the team. And if it impacts the team, it also impacts the performance of the funds. We try to understand whether the idea of understanding of parent is to, one, understand whether the fund house is investor focused or they are asset gatherers. What are the regulatory practices that they have in place? Have they had any regulatory issues in the past? How good they are in talent retention, retaining fund managers, retaining analysts. If they have seen exist, then are they able to get the talent as well? What is the reward policy? What is the compensation structure? We prefer long-term compensation structure because that aligns managers' interests and fund house interests with investors. If that's not the case, then we are a bit cautious on the parent side. Can we have the next slide? Performance. When we look at performance, we look at from the perspective of long-term and from the strategy perspective. There are certain strategies which are expected to underperform in a given market condition. If they underperform, we are fine with that. There are certain strategies which are meant to outperform in certain market conditions. If they do that, obviously this it's a welcome thing. But if any of these things doesn't match, that is where we are a bit worried and we are a bit cautious. For instance, a strategy is supposed to outperform in a given market condition. If it's not performing well, then we need to dig deep and see if the manager has changed something, which is a result of, and as a result of that, the fund is underperforming. So largely, we don't look at performance from point-to-point perspective. We look at performance from different market phases, from how it has performed over a down cycle, how it's performed over an up cycle, and obviously from the strategy perspective. Price is very important and is inherently embedded in our analysis because a higher price can have a negative impact on the performance over a longer time frame. And and that is where if you look at our ratings, we have that for direct share class, there are chances that the direct share class will have a rating a notch above a regular share class, and that difference is largely because of the expense ratio. Can we have the next slide, please? Now, the next question could be where on our website you can find our ratings. It's right up there on the homepage. If you look at the right-hand side panel, you will find our ratings mentioned there. Now, what I would like to spend some time, maybe another 5 minutes quickly, on how you can gain knowledge through Morningstar website. And there's a lot of information, data, portfolio specific, performance specific, which is available there, which will help you to do your own research and as well as select the right fund for your portfolio. If you have, once you have, it's always important to get an idea about the funds to enhance your knowledge. Even if you are investing directly or you are investing through an advisor, it's very important to have knowledge about where your finances and where your money is. So this is where on the homepage you can type the name of the fund, and you will get a detailed section. Can we have the next slide? This is where on the homepage you will find a section after you enter the name. This is the section that will open on our website, which is about on any fund that you want to capture. Now, these are different tabs which are available. These tabs points towards different sections of the fund. For example, it says overview, portfolio, detailed portfolio, risk and ratings, performance, and a fact sheet. Now, these sections deals with different aspects of the fund, and you can go through each of them to understand what the fund is. For example, If you want to know about the manager, how long the manager has been managing, then there is a section on the team, on the people side. For this fund, that is Nippon India Large Cap, you can see that Sailesh Rajban has been managing this fund since 2007. Now, what could you inference from that? The point that you can take away is that this manager has been managing for more than a decade. So this ensures the consistency in the thought process and the investment strategy. Over a period of time, this manager has been managing this fund across various market cycles, and the fund has done well, which gives a sort of comfort that, okay, this manager knows his thing. He has done that. He has seen various market cycles, and he has been a consistent factor. That is kind of a, comforting, that gives a comfort to the conviction and help in building conviction on the fund. Now, these are Morningstar style box, and what does this indicate? One, it tells you whether the fund is large, mid, and small cap. Two, it also tells you what kind of a style that the manager is applying. For instance, if it's a value style, blend style, or growth style. Now, here what we can clearly see is that it's a large cap fund with a blend style of investing, which means that here the manager invests in growth stocks which are available at reasonable valuation. So it's a valuation conscious approach. Now, immediately what it also tells us that, this fund will do well when there is a rally in the valuation conscious kind of an approach. Value stocks, when they do well, this strategy will also do well. But in a growth oriented market, for instance, of 2018, 19, 20, initial part of 2020, this strategy may struggle. And that is something that we will see when we look at the performance of this fund. You can also look at a lot of portfolio specific attributes. For example, the top 10 stocks, what has been the change there? What are the returns that these stocks have given over a 1 year period? This could also help you in understanding the quality of the stocks that the fund is holding. At the same time, you can also look at the sector-specific bets that the manager is taking. That will give you an understanding how the manager is looking at the market, which are the pockets where he's seeing good investment opportunity, and that will help you to understand what is a broader framework and the direction that this fund is taking. Risk. This is very important chart, and I would like to focus on a couple of things here. One, if you look at the risk versus category graph, the risk is high as well as the return is high, which means that this fund is taking higher risk than the category peers, but it is also delivering higher returns. So investors here can check if this kind of a risk and this kind of a return is apt for them. For investors who are not comfortable with a very high risk and they are comfortable with moderate risk and moderate kind of a return, this fund may not really fit into their portfolio. But for investors who are ready to take a higher risk for higher returns, this fund may fit into their portfolio. Performance. Here, and if I have to relate this sheet with the previous one where we were checking style boxes, we can see 2018, 19, and 20 were the 3 years where this fund underperformed. Why it underperformed? That is largely because the valuation conscious approach was out of favor. And once the cycle turned, when valuation conscious approach or valuation conscious style came back in favor, this fund started to do well. And that is what it really helps us in understanding the inherent nature of the fund and how it will perform or behave in different market conditions. This is a fact sheet. This is a short fact sheet that is also available on our website. One can look at it. An investor can quickly get through as to what the fund is, what is the portfolio, how has been the performance. A quick glance can help understand the fund through this particular section. Before we end, let's try and understand or encapsulate as to what we have learned about mutual fund investing. One is obviously mutual funds are long-term investments, and we have understood that with the help of the studies that Morningstar has done in the past. You need to diversify your portfolio, but ensure that it's not over-diversified. The right kind of a diversification is good enough, because over-diversification could be counterproductive over a longer period of time. Performance should not be the sole criteria for selecting or exiting a fund. And that is very important. Again, we have re-emphasized that with the help of the study that we have done. Performance cannot be the criteria or the sole criteria. It can be a criteria, but it should come much lower in the hierarchy of other criteria that you need to be looking at while selecting a fund. Sector or thematic funds are risky funds. They are meant for those kind of investors who can time their entry exit from these funds, who have the understanding and the knowledge about the dynamics of the sector. They know how the sector would change. If that's not the case, then investors are better off investing in diversified equity funds. If fund selection proves to be a daunting task for you, don't hesitate to consult an expert. That is something that Mr. Nilesh Shah in his talk did re-emphasize that, if you want to cut your hair, you go to the barber shop, you don't do it on your own. Rely on an expert if you don't have the knowledge, expertise, and skill set to do that. And know your funds, irrespective of you are investing on your own or irrespective of you are going through an advisor. Still, it's important for you to know your funds, know your investments, and know where your finances are. Now, that is all I have for you in this session. So if you have any questions, we will be taking up that question during Ask Morningstar session. But don't go away anywhere. Stay tuned as we have a very interesting session coming up, which is on the art of mining meaningful goals. This session will be conducted by Dr. Sagneet Kaur, who is a behavioral research expert at Morningstar.